So one of the biggest concerns for most mortgage brokers is cash flow. How do I know how to guarantee income every single month? Because guaranteed income is really, really hard. You're only as good as the last sales month, and you can't guarantee when people do or do not want to buy a house. It's really stressful. If you don't have some form of guaranteed kind of income in your business, you're going to find it very hard to maybe employ people, or maybe you're going to find it maybe stressful on your nerves. You're going to feel very anxious about it. And this is something that comes up a lot when I talk to brokers, definitely around this whole process. But there is a way to overcome this. There is a way that you can actually create some sort of income stability in your mortgage business. And it's actually way more easier than you think. But lots of people get either confused by it, or they don't really see it as an option until you start to really kind of zoom out and see it for what it is. Now, I did a post on this recently, and I'm not going to lie, quite a few people got a bit confused about it, which is quite interesting, which is why I'm making this video. And I didn't just do it recently, I literally done the post today, inspired me to make this video now, so I can explain this concept in more detail for you, so that hopefully some of you mortgage brokers out there, if you want to adopt this, you're going to be able to create really decent income. Now, my name is Ash Ball, and if it's the first time we're meeting, hello. I'm a business coach and brand strategist for mortgage brokers, helping them simplify success. And over the years, I have helped hundreds of advisors improve their impact and income. And hopefully, definitely today, I would like to try and help you do that too. So this specific post, that what people spoke about was this idea that the advisor one of my advisors I work with, they actually have got a rolling annual income now of £288,000. Now, actually, to be completely honest with you, that figure it's actually more than that figure. And what was great about this is I made this post, and then I literally got off a call with that said client pretty soon after making the post. And so we were actually going through the numbers when people were questioning it. Now, not going to lie, it's hard to do. It's not for the faint-hearted, and that number, and obviously this number of 288,000, that seems extreme. And this is per year he's making before making any mortgage sales. Okay, so that's how much money he's making every single year without having to even do mortgage sales, which we're going to talk about. But it is actually higher than that. But that's the target number that we aim for. So this is the figure he did. Now, how we actually do this, it's all based around insurance. So it's all about the protection income. And we need to take that on the drip, okay, which I call it drip, but I think that is also known, I'm rubbish with my dyslexia on this, I think that is non-indemnity, I think, is that correct? Let me know in the comments if I'm correct with that. It is non-indemnity, but effectively what that means is you're taking that money over usually a 4-year period. So you're going to take your commission over a 4-year period, so to speak. So let's say if you were you did a commission that was, and we're going to do like real conservative numbers on this. Let's say that you're doing a commission, a premium, an insurance premium of say £150 for your average client, which most clients I work with are going to be between my client brokers I work with, they're going to get between £150 to £250 premium. That's kind of their average. If they were doing that and they did times 20, which by the way, you would get more than that, up to maybe 24 if you were doing taking it on the drip, on the non-indem, but let's do it for 20 just to keep the numbers lower for people. So we do that by times 20, that would equal 3,000. So you'd make £3,000 worth of commission, give or take, on that policy. Now, if we divided that then by 48, because you would get 4 years worth of payments and you get a monthly payment for 4 years. If we divided that by 48, so there's 12, 24, 48, go on to that one. Don't know the middle one because I'm not great with that. Then that means that commission would be on that one alone, that's £62.50 per month. So that commission would be £62 per month. That would be how you make, that's how much you would get paid. So that's how much on the drip for protection you would get. Now, this means that you would get paid that. Obviously, if they claw back or anything, there's a different thing, but you're going to get paid that for the next 4 years. So you're going to, as close to guarantee, unless the client no longer use it, they don't want it anymore, you're going to guarantee that income for the next 4 years. So that is where this whole business, this whole like income model is structured on, because you're going to start to be able to bake it in. So with this specific client, what they actually did, and this number, by the way, is for them because they are a big writer with big mortgages, and they have a very wealthy client base. You don't need to be making 200 and nearly 300 grand a year on this. That's not what I'm saying this is about. But you could easily get yourself to 60 grand a year over a certain number of part time, which would cover hopefully your lifestyle, and then everything else is gravy. So let's say that we set a target, and that target is £500, which is what this specific advisor is, per month added to the pot. Okay, so they're trying to add £500 per month to that pot of income, not commission, not premium. Do not get those things confused. Not commission, not premium. £500 of income added. So that would mean that they would be looking at £500. So £500 times 48 is going to equal £24,000. That's going to be £24,000 over 4 years. That's what it's going to be. So each month you are adding another this specific person is adding another £24,000 to his business over the next 4 years. Hopefully you're following. So if we go to this, and let's go for this for now. Let me just rub that out so we can go there. Let's say, and this is where this number here came in. Now, if you are adding £500 per month, I wouldn't know what their premiums would actually be because it all depends on the providers you have and stuff like that. But let's say that you now are adding £500 a month. That means the next month, that extra 500 now totals 1,000, and then it's 1,500. And hopefully people can understand this. 2,000, 2,500. So every single month, this figure is going up again and again and again. So by the time we reach year one, this should hit £6,000. We are at £6,000 in year one, which means on month 13, if we did month 13, we're now at £6,500. So that doesn't just disappear, but that remember, that's £6,000 per month for the next 4 years of the policy. Now, yes, what you have to be aware of is that every month it's a rolling 4 years. So if you put something on in September, that's going to drop off in 4 years in September. So it's always rolling. So it takes 4 years to fully mature. But once it's fully mature, it works. So if you look at it this way, you're going to go, if you added that 6,000 for that one, then the next year you're going to be 12,000. The next year is going to be 18,000. And then the final year, because it caps out at 4 years for this specific person, is going to be 24,000. And I'm going to write this per month. That's what it will be. Now, what's going to happen is it's a little bit like a kind of a system. It's just going round. So I mean that is going round. You've got to keep dumping money, those 500s, into that system, but it'll just keep going round and round and round and round and round. So once you hit critical mass of, like, say 24,000, which, by the way, if you times 24 times 12, what does that make? 24,000 times 12, by the way, we already know the answers. I'm just doing numbers to show people. Times 12 equals 288,000. Funny that's the number we said right at the beginning when we were talking about this. That's this figure. So this was why this specific client, the target was that as long as he continues to do the same behavior that he did, as in, for example, £500 paid per month for 4 years each time, then he will make, by the end of the 4th year, which is where he's at, he's now making, he's actually, like I said, making more than this, but he will be making, roughly, he can predict to be making around 288,000, which is just shy of 300,000. So this is how this works. This is how you create cash flow in your business. Now, that figure is high, and I'm not telling you should be that high. You can be £100 per month if you wanted to. That's probably more realistic for many people. And £100 per month is still going to be pretty decent. If you do £100 a month, you're looking at 1,200 by the end of the first year, times 4, you'd be looking at the £4,800 per month, which would give you a rolling income of about just shy of 60k to 57,600. So that is probably more realistic for most advisors, is that you could have about 60 grand coming in. And then you could have, and then everything else on top of that, all your fees and all your mortgages are separate. But why is this difficult? First of all, why is it difficult for most people to comprehend? It's because the vast majority of mortgage brokers take that money up front. So they take that big chunk of commission. So this person is making significantly more than 288,000. They're not making any more money or less money than somebody who's a high writer. What they're creating is steady income. That's what they're creating. And I think this is the bit that people massively, I think it is. I don't really understand how people can't get their head around it, but it's quite an easy concept, is that you just keep layering in compounding assets over time. They're going to pay out. And that builds security. You also get paid more for taking it on the drip, for taking it on the non-indemnity, I think is what it's called. You get paid more for that because it's less risk to the provider. It's less risk to you. It's just a less risk all around. So that's how this system works. And the only reason I'm sounding very passionate and maybe frustrated, I'm not frustrated at all, but I know this works because I don't just do it with this one client who's hitting these numbers, but I do it with lots of clients. So when I put the post out, I've had a few people like DM me or message me going, that doesn't work. Then I'm like, yes, it does, because I'm literally talking to the people who are banking it right now. And the only thing that I'm a little bit shocked by was how, and maybe it's my post, but how advisors can't grasp the idea of compounding money. it's a figures thing. Now it probably is that I haven't put it out there correct, and that's why I've done this video, is that I was like, I need to do a video to show you what I mean, because it's not some sort of wizardry. In fact, it's been available to us the whole time. It's really easy. Set a minimum amount of money you want to get paid per month, or that you want to put into your kind of pot of money per month that increases your monthly spitting out recurring revenue. That's it. It could be £100, could be £200, could be £500, could be £1,000. Doesn't really matter. Work on that and then compound it. And over 4 years, if you stick to the same task, it will eventually hit a 4-year multiple. And that is the maximum amount you're going to be able to make without trying to take more on and doing more. Now, chances are some months you're going to do less, some months you're going to do more, but it does give you a target and allows you to create cash flow, which, by the way, this specific individual, but others as well, use it to reinvest in their staffing and in their software and in their facilities and in their premises. It's a really great way to create security that they know that for the next 4 years, they're going to do well. Now, one thing you have to point out with this is if you stopped selling and completely stopped selling, this number would actually go up down by a quarter. The first, you would lose a quarter of it, then you would lose the next bit. So you would lose it chunk by chunk. You would lose that year. It would slowly eradicate down to over 4 years. In the end, you'd have nothing left, which, by the way, is another great thing. That if you're looking to retire, if you wanted to retire and you built this up, guess what? You still can have an income for 4 years as that money pumps out slowly and drips that money to you to the point when it's finally stopped. If you do that, that's great. Now, if you pair this with some GI, that's even better, because GI doesn't stop compounding, so it goes bigger and bigger. But this is how this concept works. It's very, very, very simple. It's very simple. So hopefully it makes sense. If you have any questions, don't message me about them, because I've done a video about it. So I'm done. Anyway, Alan, I love you all. I'm going to leave you all. I'll see you in a bit.